and you've got the virus, and this is on page 14. This just shows you the overall XRT aggregate. It's not relative. I think it underperformed the S&P by like 300 basis points, which is almost nothing over this time period, but it's like from January 23rd all the way up through yesterday. And it shows you that you had this big spike down there initially around the end of the month, and then it just ripped right back. And the market is looking right through what's going on with this virus. Now, I'll tell you, there's two ways you got to look at this. On one hand, there are the companies who actually do business in China. These are a lot of the luxury companies like your Kering, your LVMH, Nike. Almost a quarter of its cash flow comes out of China, and they basically came out and said, hey, look, it's not in our guidance, or the guidance that we gave last quarter. Now it's, we don't know what it is now, so we're basically going to miss the upcoming quarter. That's basically what they told you. They said it a lot more eloquently than I just did. I'll tell you, Ralph Lauren, they came out and they basically cut guidance by about twice as much as they should have, which pissed me off because I think Ralph Lauren, for so many reasons, is a fundamental short. I think it's a broken company, and I think it's growing at about a fifth of the rate it should be growing in order to justify its valuation, and they just really cut guidance in the upcoming quarter and they sandbagged. Same with Canada Goose. I've been short that since 49. We covered it at 30 as the company came out and it gave guidance for how it was going to be impacted by the virus. And you could only really chalk up half of the earnings downgrade due to what's going on in China. So you got these companies operating in China, and they're all going to feel some kind of hit. Everybody knows that, and the stocks have mostly looked through it. I care more about the secondary impact, and that's having the workers at the factories right now. So you have mostly migrant workers who work at these factories in the Pearl River Delta, where they make apparel and they make electronics and they make chips and they make all these great things that fill our shelves come summer and come fall and holiday. And I know it's way too early to be talking about holiday, but it's not too early to be talking about summer because those goods are being made right now. Those migrant workers who go to work at those factories aren't at the factories. They're just not there, so stuff's not being made. So back to the point I made a couple of slides ago, where you have, because of the change in tariffs, you have fewer goods coming in from China. Now you have even fewer goods that are coming in from China and not necessarily being brought in from other domiciles. Which is going to lead to sales misses in the back half of this year. So at the same time, we have a slowing consumer environment. Comps get tough. We talked about the tough holiday comps last year. Summer looked really good last year. Now we have to comp up against those. At the same time, we have fewer goods on the shelf. So the whole punchline, I know that's a mouthful, is that we're probably going to see the companies deleverage occupancy. They're going to have e-com margin hit, which is just a reality. It's the fact of this business. You sell more online unless you're a company like Nike, and it's a hit to your gross margins, and that ends up being a pretty big problem. So this is going to be a big year of sales misses, whereas I think the consensus, as far as people I speak to, think that it's going to be more like margin hit and cost problems as far as trying to get goods here. I just don't think goods are going to get here.